I'm out of the Fort Lauderdale office, and I go back and forth between West Palm Beach and Miami. So we're all over the nation. You know, we're an accounting firm. We do tax, audit, consulting work, IT consulting, and we also help entrepreneurs that may be going through seed rounds, do consulting work there. And Alan has a ton of experience being on the street and then coming into EisnerAmper and helping some of our clients get funding in whatever ways that we can. So this is just an overview of our offices throughout the nation and the world, and we are currently growing, and hopefully we're going to be in other cities in Florida sooner than later. EisnerAmper, we spend, a lot of focus is real estate, life science, tech, but a main specialty of the firm is hedge fund, accounting, tax work, audit work as well. So we have a ton of awards dealing with hedge funds, as far as being a fund accounting firm, doing tax work, audit work, and these are just some of the accolades that we have. And you're going to see a lot of them are fund-based because we have a large specialization in that area. And in a quick overview of just kind of what we've noticed that's happening in, within this last 2020, because a lot of questions that I hear from people are, is anyone investing in the era of COVID, right? It's already hard enough to get investing and get capital and get money, but now COVID has really put a spin on this that's more challenging than ever. But I think there's some bad news, but there's more good news than bad news. Would you agree with that, Alan?
Absolutely, Paul. And, I think that's a really good segue into, just a brief description of, what's going on in the VC market and, the early stage investment market, both nationally and in Florida. But just one real quick housekeeping item. I know there's a chat function here. If people want to post questions during the presentation, we're certainly going to be monitoring that. So we just want to leave enough time at the end of the presentation for people to ask questions. And so if you have a question during the presentation, please don't hesitate to post it online. But getting back to the market, I think to everyone's surprise, and oh, thanks, Paul. I think the VC market and the investment market in general in the technology and life sciences space has been much more resilient than anyone ever thought. I think back in March and April, people thought the world was coming to an end, deal flow was going to stop, investors were going to stop in their tracks and not complete investments. But I think just the opposite occurred. And the headline of this slide, economic volatility does little to impact the VC market, I think really almost understates it. In the third quarter of this year, there was almost $38 billion invested in almost 3,000 deals, which exceeded both totals for deal volume and for deal value of the first two quarters of 2020, when the world was a different place than it is today. I have to admit, a lot of the activity has been skewed towards larger deals. For example, in Q3, almost $27 billion was invested in later stage deals, Series C or later. So it represents a good deal of the number. There is a slowdown in terms of seed and early stage funding, compared to the mega round deals of $100 million. Mega deals, the deals over 100 million are really on a record-setting pace this year. We've seen 223 deals over $100 million invested in by VCs. That's a large number. Also, we're seeing a large number of VC-backed exits. They reached almost $104 billion in the second quarter, second highest quarter on record. The IPO market has been very vibrant. We've seen 13 IPOs of companies with values greater than $1 billion just in the third quarter alone. And then the last piece of this is really the SPAC market, which has come back to vogue. And we've seen, over $40 billion of SPAC money raised in the first 9 months of the year. So, to kind of summarize that, we're seeing great investment activity, we're seeing great exit values, and we're also seeing really good fundraising for venture capital funds. So it's almost a perfect market for everyone. So, the good news for everyone listening to this call is if you have an idea and you're looking for capital, it's a really good time right now. I think, the tech space has, almost gotten a new life as a result of COVID-19, where technology has become just so much more important to everyone.
Yeah, there's definitely a lot of opportunities now that maybe not have been there, and we were trending in a certain area, and I think COVID just accelerated it, right? Especially, just think of something as simple as working from home, which we were trending to a little bit, but that got pushed 5 years in advance to where it probably would be. And I think that same thought process is being applied here from what Alan was saying.
And Paul, I think, the best line that I've heard throughout this entire pandemic was from Andrew Yang, who was a former Democratic presidential candidate. And Andrew said very early on in this pandemic has caused us to see 10 years of changes in 10 weeks. And I think we were able to do that because the tech ecosystem in this country is so advanced and allows us to work remotely, shop remotely. We're seeing, remote, telemedicine. It's just amazing what we're doing. And it's just an indication of what the future is going to bring. And I think a lot of the changes we're seeing in how we do business now as a result of COVID are going to be permanent. Paul, next slide.
Okay, we're going to talk a little bit about the Florida venture market, which I'm sure a lot of people are interested to hear. And especially being in South Florida, where I would say the majority of the venture capital is deployed within Florida, is coming down here, especially like in the Miami area. From what I've seen is a big area for the capital. But just through the first 9 months of 2020, 1.4 billion has been invested in almost 210 deals, which is pretty amazing. I mean that's a good number for being in COVID. It is, unfavorable compared to 3.1 last year, but it's still, a healthy amount that's being deployed in Florida, which is great. And again, later stage deals are dominating these. Do you think there's a reason why later stage deals more than seed? Is it just a risk, just a function of risk in this?
I think part of it is, I think that there's a lot of money out there chasing deals, and some of these very large venture funds have to write big checks, and they are certainly doing that. And it's funny because you're seeing both this uptick in these mega rounds, $100 million plus rounds, and you're also seeing an extremely vibrant IPO market. If you would have said this a year ago, we were in a situation where companies could continue to raise private capital and didn't have to go public. And now all of a sudden you're seeing both. They're raising large pools of capital, and you're seeing a very vibrant, public market for IPOs. So it's a really interesting time. Also when you look at, South Florida or the Southeast United States as a part of the tech ecosystem nationally, it's becoming more important. Almost 8% of the deals, the venture capital deals done, in the third quarter were done in the Southeast. Last year it was only 6%. So you're seeing, Florida and the surrounding states be a more important part of this ecosystem. And I know I do spend a lot of time in Florida, and I think, people are looking at the Florida market as a great place to place VC dollars. I mean, the state has really advanced in terms of its ecosystem, and organizations like, Palm Beach Tech have been a big part of that, to encourage entrepreneurs to take their ideas forward. And I think that'll certainly continue in a big way.
Yes. So thank you, Palm Beach Tech, doing your part, as we all are doing our parts to kind of take Florida to this next level. And it's something that I'm really excited about. It's one of the reasons why I got into working with tech companies for my career and my specialization, just because it's a booming market and it's exciting. it's really great what's happening down here, and to see the number of deals that are happening in South Florida and the uptick of deals, larger numbers, it's really good. And it's not just all coming from Magic Leap anymore. That was our main pusher for so many years, and it still is. It's amazing, but there's other deals coming besides for Magic Leap.
And Paul, that's a great point, because when you look at 2018 and 2019 venture capital numbers in South Florida, so much of it was skewed by Magic Leap. It was such a big deal. And I'll just make a personal point, and I know my colleague Christine Gagnon is also on the call with us. I know when I first came to Florida, looking at the tech community, 3 or 4 years ago, I was amazed at the vibrant ecosystem. I went back to our leadership and I said, we have to spend more time down here. This is an amazing market. There are great entrepreneurs building great companies. Your university system is collaborating together and just doing amazing things. And I'm involved in the tech community in many parts of this country, and I think you guys are doing as good a job as anyone, and I really mean that.
Yeah, I would agree for sure.
So, Paul, why don't we, let's talk a little bit about, capital formation. And, I know there are probably a lot of first-time entrepreneurs on this call, or entrepreneurs who are trying to raise capital for startups where, they don't have revenue yet, they don't have customers yet. Because the tough part today is that, even with, angel investors or, high net worth individuals, they all want to see some level of validation before they invest. So as a result of that, the toughest money to find is that money before you have any evidence of revenue, any evidence of customers. When you're trying to raise, a couple $100,000 or a couple $1 million, and you're trying to build out your minimally viable product. It's very, even today, where a lot of money out there, it's a tough, those first dollars are very difficult to raise. And I think a lot of what I'm going to say here is probably self-evident, but let me kind of mention it anyway. I think you have to be creative in raising this early stage money today. And you have to be able to access, you have to put some of your own money in, whether it's savings or using your credit cards or home equity lines or whatever it might be. A lot of companies, the founders will do some consulting to supplement their income and kind of work 2 jobs at the same time. Look, the situation of creative facility solutions probably is not that relevant anymore, because a lot of people are working from home. They don't have to be in a WeWork facility or other places like that. I certainly encourage efficient work, efficient management of working capital. Every dollar is important. Take advantage of government tax incentives. Look, I know a lot of self-employed individuals and independent contractors took advantage of PPP loans that came out in March and April of this year. If you can get advance payments from your customers, that's important. Non-equity crowdfunding is a way of accessing capital. As a final thought, equity is the most expensive form of capital there is. So you have to be, conscious of the fact that if you are successful in raising money very early, you're going to be giving away a significant piece of your company. So if you can raise money in other ways without having to give up equity at this early stage, try to take advantage of it. The saying is, stay in your garage as long as you can, and be conservative with your capital.
Those are excellent points. I mean, especially about just being efficient with the capital that you have, and that kind of segues into, once you get the capital, dilution is a big topic that entrepreneurs don't like to hear about sometimes. But there's pros and cons to everything, and this is definitely one of the areas where I was just on the call actually yesterday with an entrepreneur that could get a large sum of money that just didn't want to give away any of his company, not a cent of it. But to think about it, someone's going to give you millions of dollars and you think you're going to be extremely successful and you're still going to be able to keep 80% or 85% of all your profits. Not that bad of a deal, is one way to look at it. And I literally just had this conversation yesterday.
This has been sort of webinar week for me. I have to be quite honest with you. I'm on 6 webinars this week in like 4 different states. So I was actually on one yesterday with a venture capitalist, and one of the questions came up of what they look for when they put money in on a pre-seed or a seed round, and they're typically getting 10 to 20% of the company, for those first dollars in, But the key takeaway here is, dilution isn't necessarily bad because you need to raise that money if you've exhausted all other alternatives. But the most important point here, and I'm a really big proponent of this, raise the amount of capital that you need, not the amount of capital that you want. And you really have to understand need and how that capital is going to be deployed and what milestones you're going to achieve. And you have to realize if you achieve those milestones and are going to raise another round, you're probably going to be doing it at a much higher valuation. And that's what every entrepreneur wants to do. You're going to raise capital, and each successive round, you're going to give away less and less equity because the value of your company is that much greater. So I think it's really important that as an entrepreneur, you understand what your monthly cash burn is going to be. And I think you really have to get to a very granular level to do that, because the one thing you do not want to do, especially after you raise money from a venture capitalist, is run out of money. So running out of money is certainly a no-no. And you really want to understand how long that capital is going to last. And if you ask most VCs when they invest in a deal, that they want that capital to last probably 12 to 18 months. And I think when they're investing in a seed round or a Series A, they realize that other rounds of capital are going to be necessary. And they just want to make sure that you, as the entrepreneur running this organization, knows how that capital is going to be deployed and how long it's going to last. So the one key takeaway, and I've said this to a lot of entrepreneurs, raise the amount of capital that you need, not what you want. And there's a big difference.
Yeah, and I'm sure, going out for your first couple of rounds and someone's going to give you a large amount of money, maybe more than what you need, it would be very hard to turn that down or to not take anything. But it's, what Alan's saying is really important. It's appropriate to raise the correct amount of money to avoid that, that down round, and to, have your goals and your milestones organized in a way so you're hitting each round a different milestone and you can fully fund it to each milestone or goal and then have another round.
And the other thing to keep in mind, when you're thinking about your cash needs, good people are expensive. I'm actually working with a Series A company now in San Francisco that's going through some really tough financial problems. And they're at the point of kind of running out of money. They need to raise a bridge round very quickly. And we're talking about ways that they can conserve cash, and headcount becomes a big issue. If you're a company in Northern California, hiring computer engineers is not easy, and these people are not cheap. So remember, when you're thinking about what you're going to need from a cash basis, hiring good people is really critical, and those good people are going to come with a cost. So make sure you make those decisions in a very prudent manner, because it could come back to haunt you later on.
Just to finish up these slides, in all these rounds is going to happen. You know, you're going to receive the equity and the capital. You're going to have to give some portion of your company up in most scenarios, and for the most part, it's a good thing. You're growing something, and I think Alan told me this once, but it's better to have a smaller amount of something really good than have 100% of nothing.
Yep. No, that's a really good point, Paul. And don't underestimate what it costs to hire people in your organization. And I know for a fact that, you know, South Florida has become more of a tech hub. It's a great place in terms of quality of life for a lot of a lot of entrepreneurs and computer scientists to live. And as time goes on, you know, demand is going to be greater than supply, and the cost of those people is going to go up tremendously. So factor that into what you think your cash needs are going to be.
We briefly spoke about this before, but you want to raise the right amount of capital, because you want to avoid down rounds. And, you know, a down round is where your valuation actually goes down because you raised too much money in previous rounds. And that's, you know, it's no investor wants to see that, and no future investor is going to want to invest in a company, you know, that had the down round. It's kind of like a black mark on you a little bit. It's not the best situation to be in.
You know, and I'll give you an example, Paul. This company in San Francisco that I'm working with is, you know, trying to raise a bridge round now, and it's you know, certainly something that's necessary. And one of the terms of the deal for this bridge financing, and it's at a much reduced, it's a convertible note, so it's a much reduced, you know, valuation cap, you know, from prior rounds, and they're actually offering investors a 4x liquidation preference on their money. So there's you know, you really want to avoid down rounds. It really is a tough situation to get out of. You know, but you know, the earlier point of, you know, raise what you need. You know, sometimes when you raise too much capital and you give up too much equity early on, it's a problem, because, you know, if I'm an investor in later rounds and I see an entrepreneur who only owns a small percentage of the company, the incentive for that entrepreneur and that team to work really hard to achieve the goals that we all want kind of goes out the window. And also, when you raise a larger capital round, the costs are much higher, and the time to close is much longer because of, you know, higher levels of due diligence. So certainly keep that in mind.
A couple of key takeaways, and I think the biggest one, you know, raise enough to get to your next milestone, which we talked about. You're probably going to need about 6 months of cash needed for your capital raise, so you have to kind of plan that out properly to make sure you have enough time and you don't run out of money in between where you know you need to get the cash to where you actually get the cash. It could take 6 months to, you know, to fund that. So you have to basically plan, and that's really understanding what your cash burn rates are on a monthly basis is very important. And that goes back to budgeting. You know, something very simple as budgeting is so important for all of the especially in the startups and any business in general. But, you know, budgeting and your cash forecasting and your cash burn rate and understanding those numbers are very important, because investors are going to grill you on those numbers, and you have to like know them front and back and understand them.
You know, one other thing to add, when you look at the cost of capital, and for, you know, first-time entrepreneurs who might not be finance people, when you look at the cost of capital, and capital comes in sort of three buckets. There's debt that you get from a bank, and that's the cheapest form of capital there is. There's a sort of a hybrid product called mezzanine debt, which is sort of debt and equity, which is the next most expensive element. And then equity is the most expensive form of capital there is. And, you know, to give a simple example, if, you know, you raise $100,000 and you have to give away 10% of your company, and you have an exit and the company's worth $10 million, that 10% slug cost you $1 million. That's a lot of money to raise $100,000. So it's a tough example to swallow, but just remember that, equity has a cost, and it is pretty expensive. So let's talk a little bit about, where do you go to find, pre-seed, seed, and early stage capital. It goes without saying, you always, when you raise, a couple $100,000 to kind of get things going, don't hesitate to go to friends, family, what I call friends, fools, and family. And, it's a relatively easy way to raise money. But the most difficult thing is to tell a friend or family member that you lost their money. So that's a conversation you don't want to have. So where do you go? Certainly, high net worth individuals, individual angel investors. And once again, a lot of these people don't hang a shingle that say I'm a high net worth individual looking to raise money. So, talk to your advisors, whether it be your accountant, your lawyer, people in the community who have access to high net worth friends that, you'd like some introductions, because at the end of the day, a warm introduction goes a lot further than anything else.
And you never know who you're going to meet. Just being out there, just being out in the community, you never know who you could run into at a Palm Beach Tech event, at another tech event, in South Florida. You just don't know who you might run into that knows someone that likes your idea. You just don't know. It comes in very strange and odd places.
And also, don't be afraid to ask for advice. Another saying is, sometimes you ask for money and you get advice. Sometimes you ask for advice and you get money. So don't be afraid to talk to people about your idea and the fact that you are looking to raise capital, because sometimes you ask someone for advice and they say, well, this sounds so great, I think I'm going to invest myself. So don't hesitate to do that. There are a number of established angel groups across the country. There are far too many to mention. I personally sit on the board of two angel groups, one in New Jersey called Jumpstart New Jersey, and one in Philadelphia called Robin Hood Ventures. And, these are classic, pre-seed and seed stage organizations that, collectively will write checks up to about $1 million. There's an organization called the Angel Capital Association where you could get the names of all these angel groups around the country, and there are literally hundreds of them. So take advantage of that. There are a number of institutional early stage venture funds that, typically do invest in pre-seed and seed stage rounds that'll write checks as low as $250,000. One group that is certainly not really taken advantage of is the corporate venture capital market. I bet you that 75% of the Fortune 500 companies have captive venture capital groups within their organization that are looking to invest in the next technologies that are going to impact their organization. So take advantage of the corporate VC market. Family offices, once again, your law firms that you work with, your accounting firms should know some of the larger family offices in your region, and they might even be able to make an introduction to you. Hedge funds. But the most important point is network to get introductions. Utilize your network, LinkedIn today, of course, because getting a warm introduction will get you closer to someone who can write a check. And just keep in mind that these people who are writing checks are literally seeing thousands of deals a year, thousands. So you want to try to get to their top of their pile very quickly.
And there's a number of angel investors like in South Florida, and as a firm, we've hosted basically networking groups with them. We've done presentations with a couple angel groups. So they're active in South Florida. It's just getting involved in the right networking groups and getting introduction to those events. And we're going to talk about the capital metrics kind of briefly. We'll probably go through this a little bit quicker, but this is where Alan is a specialist above all things, maybe a little bit more than me on exactly what VCs are looking for.
So one of my, I've done this presentation to, around the country many times. And I think the two issues that entrepreneurs struggle with more than anything is number one, how much capital should I raise? And number two, why do VCs say no? And unfortunately, and I don't care if you were Mark Zuckerberg or Bill Gates or anyone, early on in the tech history, um, investors say no far more often than they're going to say yes. And I think entrepreneurs don't understand the type of returns a VC expects to get out of a deal to justify making that investment. And, if I think about the 5 factors that a VC would look for in a deal, and we'll talk about some of the financial metrics in a couple of slides, but I think what a VC looks for, which gets them excited, they want to see a large growing market. They want to see a proven management team or that has achieved, some prior exits. I think, they also want to see a team that's really enthusiastic about their business. I mean, enthusiasm is so important. Um, they want to see a disruptive product or technology, and I think different investors will define disruption differently. They want to see, relatively high barriers to entry. And, the most difficult thing is they want to see some level of market acceptance or what I'll call validation. And I know, for example, one of the angel groups that I'm on the board of, when we talk about validation, it's not a crazy number. They don't want to see, $1 million of monthly recurring revenue. They just want to see a trace of that. They want to see that a couple of customers are paying a price for that product or technology. They want to see some low level of acceptance. Here's where it gets a little bit interesting from a venture capital standpoint. Some of the financial metrics that they're looking for, and once again, VCs are taking an enormous amount of risk because they're typically some of the first money in a deal, and the company is so far from an exit at that point that money is at a very high risk, and they're expecting a very high return. So probably, first of all, venture capital it's a game of thirds. If you're a venture capital firm, even though you expect every deal to be enormously successful, that's why you're investing that money. The reality is that a third of the deals that they do are totally written off. If they invest $5 million, they get nothing back. A third of the deals, they only get their return of capital. So if I invest $5 million, 7 years later, I'm just going to get $5 million back. So all of a sudden, that's not a good position to be in. A third of the deals are the home runs that we all read about in the paper. Whether, the Chewy deal, for example, in South Florida a couple of years ago is a good example of that. Those are the deals that return 10, 20, 30, 40x to a fund. And those are the deals that really give the fund the investment return they need to show to their limited partners.
I found that metric to be very interesting. Like when going through this, like to have that huge, the bulk of the fund return on a third of the investments, even though, they vet these investments so well, they spend so much time speaking with them, looking at the forecasting, believing in the idea, believing in the entrepreneur. And these people are very intelligent and very experienced in what they do, but still it's so difficult to succeed that even throughout that whole vetting process, you're only looking about a third of the fund's return to come from, from those projects. It's very interesting.
So if you look at, and Paul, that's a great segue into, if you look at the fund, what a fund expects on all their investments, they're looking to get 7 times their invested capital back in 7 years. And there's a chart in a couple of slides that'll show, time versus return. 7x in 7 years is about a 32% return, 32% IRR. So that's what a VC is looking for, knowing that a third of the deals are going to give them nothing, a third of the deals are going to get their capital back, and a third of the deals are going to give them a return. So if you're sitting across the table from a VC and that VC is thinking about investing $5 million in your company, what they're saying is, can I get $35 million out of this company in 5 to 7 years? And you have to think about the same thing as an entrepreneur. Will my company be worth 7 times this, 5 years from now, or in a reasonable amount of time? So, you have to think about those metrics when you're sitting across the table from a VC. It's really important, because if they feel they can't get those types of returns, they're going to say no. Paul, next slide.
Yes. And just, if you're going to fail early.
Good point. So it just, and I know we're kind of running behind on time a little bit, so I'll try to speed this up. This just kind of shows the type of IRRs and return on investment that investors at various stages would expect to see. And once again, as time goes on, both the IRR and the return on investment decrease because the risk has been reduced. The risk return trade-off, very early on, someone's taking a tremendous amount of risk, and that risk decline is de-risked as the company begins to show more and more traction. Next slide. This was the matrix that I wanted to show before, and I think if you look at 7x over 7 years, it gets you to 32%. But this is how VCs look at deals. This is their expectation. So you got to find your way into one of these boxes, and you have to sell a compelling story of how you're going to get there.
I think this first point is very important for the early stage companies. It kind of speaks onto why there's so much risk involved, and the bulk of the deals are done at later stage, is just because it's an art, it's not a science. The forecasting is all over the place. There's no historical data. There's probably no revenues. So it's really believing in the entrepreneur. It's believing in an idea at that point almost, and it's an art. And it goes to show, why some of these VC funds are better than others when they can kind of feel that out and get to, the correct companies.
And when you start thinking about valuation, and for people who have done this before, or people new to the game, the phrase you're going to continually hear is pre-money and post-money valuation. And just to simplify it down, your pre-money valuation plus the amount of investment you receive is your post-money valuation.
Very important.
So it's really, it is basic, but you're going to hear this phrase over and over, especially as you get term sheets from potential investors. When you talk about, negotiating valuation, and valuation is, sort of a gray area. One of the reasons that convertible notes came into vogue with seed and pre-seed money was the fact that, investors and entrepreneurs had a really difficult time agreeing on valuation. And so convertible notes allow you to kind of defer that discussion of valuation until the next round of capital is invested. But I think, what determines valuation, some of the factors, it's the market opportunity. It's the size of the market. How big of a market are you selling into? It's the credentials of the management team. And, I'd be remiss if I said, second-time entrepreneurs have a much easier time raising money than first-time entrepreneurs, especially if they've had a successful exit. And the other part of that is if you have had a successful exit, and you're starting your second company, an investor is typically going to ask, what happened to your management team from your first deal? And investors really like to see if there's been some continuity of management team from a successful exit to your next opportunity. They want to see a product and solution that is, certainly achievable and certainly scalable. And they want to see progress. They want to see, validation. And, at the bottom, better answers equals reduced risk, which equals higher valuation. And, that's what you want to get to. And you want to, be well prepared for investor meetings and be able to tell a really good story. And then, it goes without saying that if you're able to do that and you have multiple offers from investors, then you're in a really nice competitive position, and you can have investors competing against one another, and that does a great deal to raise your valuation.
I like to think about it as, we get into these numbers and percentages and rate of returns and all this stuff, but at the end of the day, you're telling your story, right? And you got to present your story in a way that puts you in the best possible light and wants people to invest in your company. It's just, you're telling a story. A lot of times the entrepreneurs aren't, they don't have the financial background. They don't, they're not accountants or, analysts. All you're doing is telling a story, but you just have to tell a story in a certain type of way, and it's your story to tell. I think we can quickly go over these just because of time restraints, but these are the, in early stage companies, this is the main capital structures that you're going to see when the VCs invest in the company. Common stock is typically just for the founders or incentive programs, such as like restricted stock, or if you have stock options for your employees, because you don't have the cash to pay them what their fair market salary is. So a lot of times they might issue stock options to the employees. The convertible preferred stock, which will convert into common stock at a certain time. Convertible notes, convertible debt. This is what I see the most, at least in my experience. I don't know if you'd agree with that, Alan, and yours, but a lot of convertible notes are important because there's no equity at first. It's just a debt with interest being paid on it, but there's going to be some trigger where it's going to convert to equity at some point in time, rather it be a certain milestone, a next round, but that's popular from what I've seen, at least in South Florida and in my practice. And then there's these, the simple agreements for future equity, which isn't debt or equity. It's really just an agreement for warrants for stocks at a later time.
And just to add, two things to what Paul said, with convertible notes, the kicker for an investor is the fact that you're limiting what the valuation would be. So at a minimum, how much equity you're going to get. The valuation is determined at a subsequent round, typically the first professional round that comes in. And the benefit that you get as a convertible note holder is you're able to convert your debt into equity at that next round at a discount to the value you receive from a professional investor. So for example, if a professional investor pegged the value at $10 million and your convertible note carried a 25% discount, your conversion would be at 7.5 million. So it's a very attractive deal for investors.
A little background on each of the methods that we talked about. Probably can just go through this, and if there's any questions on it, we could answer it. So we only have about 6 minutes left. The convertible preferred stock, convertible notes, and the agreement. Do you see? Would you agree that a lot of these funds, the investments, at least start out in the early rounds with convertible debt? Is that something that you see a lot, Alan?
Yeah, I'd say probably 80% today, Paul.
Okay.
because as I said, it just defers the valuation discussion down the road to a point where there's better information in terms of pegging a value. So,
Go ahead.
go ahead, Paul. I'm sorry.
No, and now our final topic that we're just going to wrap this up with is the management team, board of advisors and board of directors, which is extremely important for small companies to have someone on your team that's done this before, someone that has experience, either they've had a prior exit before, or maybe they're just, have a lot of experience in the industry that you're in. Someone to bounce ideas off of and someone to get advice is just so important. You have your advisors that you pay for, accountants, attorneys, consultants, but to have someone that's on your team that intimately knows your business and knows the industry is a huge plus and definitely recommended. And investors are going to ask for it. Where's your advisory board? Who's on your board of directors? And you can at least start with an advisory board and then later move to a board of directors.
And just one other point to that, and I absolutely concur with the necessity of a advisory board and a board of directors. But one thing even better than having a board is having a board that has invested capital in your business. If they have skin in the game, that's even better to attract additional investors later on. And the headline of this slide, there's no such thing as a solo entrepreneur, is really important. It's about a team. And another phrase I use all the time: investors invest in the jockey and not the horse. So they're investing in people more than they are ideas.
You just want to vet the people that are on your management team and really don't just take people that are willing to be on your management team. You really want to choose the right people and make sure this is a partnership. This is a partnership you're going to have with your management team. It's really important that you guys are on the same page and you just don't say yes to, the first person that volunteers to be on your management team.
And it's really important to vet your people. When General Motors makes a hiring mistake, nobody knows about it. The organization's so big. When your company makes a hiring mistake, it could be fatal. It could put you out of business. So just make sure you vet the people and make good hiring decisions.
Absolutely. Your people, it's your strongest, it's your internal capital. It's going to make or break you, the people that you bring into your organization. It's so important, especially when you're so small. Every hiring, decision that you make is vital. So you want to empower your team, honesty from the leader. Everything starts from the leader down, and it's really important to have that culture within your company, and you're going to be the one that's going to set that culture. So it's very important to understand that and to get the right people in there. This is a great quote. It's so true. Even in a large firm like us, where we have 2,000 employees, you really have to treat everyone like giants so you can be a company of giants. I think that's an excellent quote. I think this is great. This is probably one of a really telling slide. The really why startups don't make it. No market need, obviously huge, but look at the third one, not the right team. That's very telling of the struggles that these startups have. Your advisory board is really going to be your think tank. Advisory board is different than a board of directors because advisory board's not making any decisions. It's really it's just someone to bounce the ideas off of. It's someone just to give you advice. Set of people that have interest in your company to succeed. That's really what you're looking for with an advisory board. Main differences, the board of directors is more of I look at it as more of an official board in titles where they have some especially if they're investing in the company, they're going to have a lot of say and they could have personal liability compared to the advisory board where it's really voluntarily. It's people that just want to be there to help you succeed. But I think of the board of directors as more like a formal title. Would you agree with that, Alan? Kind of
Absolutely.
Something that's going to happen maybe a little bit later in your company.
And remember, an advisory board has no fiduciary responsibility where a board does have fiduciary responsibility. So there is a big difference. And once again, I see a lot of companies that have advisory boards. You want people on those advisory boards who are really going to contribute and be a sounding board for you. And try to get an advisory board from, many different disciplines, whether it's from the financial side, the legal side, the marketing and sales side, the operations side, people who really you feel comfortable going to and asking questions or asking for advice.
Absolutely. Functions of the board of directors, kind of, what you think it would be. And it's just an appointment by the CEO. And I think we're almost at 11 o'clock. So those are the end of the slides. And maybe we could just take a couple of questions. I can look in the chat. I wasn't able to look in the chat because we were sharing the screen. But thank you, Alan, very much for your time. And if there's any other remarks that you want to make before we go to the questions.
No, I just want to thank everybody for listening. I hope you got some valuable information. Please don't, hesitate to reach out to myself, to Christine, to Paul. We're here to help you, and we look forward to hearing from many of you and working with many of you.
Yes, thank you, everyone.
If anyone has any other topics that they're interested in hearing presentations on, please reach out to Nikki and the crew at Palm Beach Tech so we can, work on our next webinar.
Yeah, no, thank you all three of you guys for being here. We're definitely going to send this recording out to all the attendees. I know, Francine, you said you'd like to rewatch this a few more times. And we're also going to share their contact information with all of you guys that are on here as well. We're going to have a huge push for 2021 in our startup community in South Florida, just a heads up. So we're definitely going to have to invite Paul and Alan back to the stage. And if anyone has any last minute questions for them, I know we're right about at time, but Francine, it looks like you had a few questions. Do you just want to jump in real quick and share your
Right. Yeah, as an aerospace engineer, I know that really great. But when it comes to the financial world and how to start a business, there's so many things that you can do wrong if you don't set yourself up correctly. So this is a really great information. But the biggest thing is, as a new startup company, how do you set up your financial sheet or statement or whatever that's called to include all the operating costs and make sure that when you're asking for angel investments, that you're only asking for what you need and making sure that you cover everything that you're going to pay for initially. So I'm in my garage as long as I can, but I can only be there for so long. So just trying to figure all that out.
It sounds like you probably need a proper accounting structure put in place. So you have financials on what you've, so far accomplished. A profit and loss statement and a balance sheet are two common statements that you're going to have. And you could, that's your starting point. That's your foundation. And then you can kind of forecast it out.
And Francine, just and I don't want to, give ourselves a paid commercial, but we actually have an outsourced accounting function where we work with a lot of entrepreneurs and basically are their outsourced accountants, and provide them with the financial information they need to be able to run their businesses. And
that's great.
We use a couple of different software products. It's in the cloud, and it's really simple, and it takes that responsibility away from you so you can concentrate on building your business.
Right, because I have the product. It's a great product. I have my website. I have the basic stuff. But when it comes to this scenario, it's who do you trust to do your accounting and, all these pieces that you need. It's great to have somebody that is knowledgeable and that you can trust. So thanks.
So you really should reach out to Paul and discuss what you need with him, and he could certainly help you.
Yeah, that's
awesome.
Actually kind of what I do. I spend a lot of my time. I'm part of the cloud accounting group. So, I first started on the tax side, and then we realized working with tech companies, the books weren't kind of where they needed to be for investors to look at it or even to prepare a tax return. So we kind of developed this product where we work with them monthly and we get them their P&L and balance sheet on a monthly basis and just make sure their accounting's where it needs to be.
Yeah, awesome. The biggest thing is knowing the tech jargon to know what to ask.
So. Yeah, it's intimidating. I think so. And then that's why I kind of you're telling your story. We're just doing it with numbers.
Awesome. Thanks. I'll reach
No
out
problem.
later.
Yeah, I put my information in the chat.
All right. Well, I know it's 11:05 and I want to be time certain. So again, thank you, Paul and Alan, for joining us today. We're going to bring you guys back in 2021. I think it'll do everybody in our community a favor. And if anyone needs anything, we're here, Palm Beach Tech, and we look forward to our next workshop. I hope everybody has a great weekend. Paul and Alan, any final words? You can jump in as well.
Just happy Thanksgiving, everyone. Everyone stay safe and sound.
Yeah.
Yes, stay safe.
All right. Thank you, guys. Have a great day.
Bye.
Okay. Thank you.
Bye.
Happy Thanksgiving.